Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Hari, and we're going to be talking about current events and what's going on in China right now and how it'll could potentially impact your portfolio. And is it time to also look at China for an investment purpose? Before we get started with that, just do a quick disclaimer here. Our podcast is a podcast used for educational and entertainment purposes. We are not financial advisors. We don't know your specific financial situation. So please consult with the appropriate advisor before making any financial decisions. All right. So if you've been following the news in the last month or so, you've been probably seeing a lot of things going on in China. A lot of Chinese companies have actually taken a huge hit in terms of stock price. And there are a lot of things that are going on there. One of them is a company called Evergrande. I actually don't know how to pronounce that, if it's Evergrande or Evergrande. I'm going to just say Evergrande from here on out, who is a enormous real estate developer in China. And Evergrande is actually heavily indebted to the tune of over $300 billion. That is billion with a B, not with an M, in case you can't hear my B's and M's. In the last 2 weeks, they've missed two interest payments in the, and what happens is, typically these companies will collateralize their debt against real estate property that they have, that they're either building or that they already own, and using that asset as the collateral that they will get a loan off of. So some of that loan is actually both onshore and offshore. So they have bonds that have been issued, they have loans from banks, and they have numerous things that are kind of causing, investors some concern, because they've missed a $47.5 million bond payment and an $83.5 million bond payment, and haven't really given a great explanation as to what they're planning to do here in the future. So why does this matter? I mean, it's a private company or a publicly traded company in China, but why does that actually impact the rest of China? Well, a few things that are kind of important in the way that China operates, and an important kind of distinction that we all need to understand when we think about China is that the Chinese economy is heavily focused on real estate, and about 80% of household wealth is tied to real estate. As people have moved from rural China into the urban areas, there's a dense growth into these different levels of cities. So China has tiers of cities based on their size and scale and that kind of thing. And huge growth in the last 20 years has led to somewhat of an asset bubble in real estate, because a lot of people are spending, getting loans, buying real estate with those loans, and then using that, to grow their household wealth. And so what has happened is companies like Evergrande have been out in the marketplace using, essentially building properties, apartments, houses, etc. And then they're heavily leveraged. So in the last year and a half, we've seen, with all the COVID changes and a huge shortage in supplies, a lot of things have kind of hit, a snag. And so this typically happens with debt, financed anything. You end up creating, people have to pay off the debt. They have interest payments that come due, monthly or weekly or quarterly, more likely quarterly than weekly. But and when those monthly payments are missed, you have essentially a certain set period of time to rectify that, that payment. Otherwise, the debt goes into default, and then you have to, the bondholder or the owner of the debt will have to sue in court to try and get things, resolved. if a company is unable to make that debt payment, and they have an $85 million debt payment, 83.5 million, sorry, but they have 300 billion in debt, you can imagine that there's a pretty big amount of debt that they're unable to pay at this point. So what will happen in a normal situation is bankruptcy may be an option where they have to sell off a bunch of their real estate assets. And as a result of selling off those real estate assets, they can pay. But there's a problem with that, which is you're probably not going to be able to sell it off at the same price that you would get if you weren't doing a fire sale. And as a result of that, if they don't have the money to make payments, they probably don't have the money to continue finishing the build out that they've made commitments to for new apartments and so forth. So you can see how this could, really create a problem. There's lots of people who are expecting this. They've put money down, or they've actually taken a loan. And if the house isn't built, there are ripple effects that create this, from this, event. And since the property is such a huge component of this, every time you start selling property in a fire sale, what you end up doing is devaluing the property as well. Because now, entrepreneurial or, people with a kind of a, big bank account, a lot of cash available, will go in and swoop in and make offers to buy these things out at, 80 cents on the dollar, 50 cents on the dollar, and so on. So what China is actually trying to do to mitigate this is not step in and shore up Evergrande by itself, but actually limit the ability to sell these properties, and reduce the prices. When before they put in these price floors and this, limiting the discounts, prices were already dropping by 40% on some of this stuff. So if you imagine, this can have a huge impact on household wealth. Cash will become scarce as people start hoarding their cash because they're worried about what's going to happen, or they'll try and sell to convert it into cash so that they can, essentially keep their rainy day fund filled. So there's a lot of things that this could also do, because there are bondholders outside of China, mainly the U.S., that are holding bonds for Evergrande, and Evergrande has not paid them, for this. So there could be knock-on effects that go beyond China. A lot of experts are saying that they don't expect that to happen, which is what happened with Layman Brothers in 2008. So for those of you who are unfamiliar, when Layman Brothers was holding the bag on a lot of these credit default swaps and other things, as the swapping of assets occurred. So if an asset falls below a certain amount of value, what will happen is there's a credit default swap, which is a vehicle to protect you against losses. So when that happens, in a small amount of losses, the credit will swap to another asset, which is fine. It'll limit that, but they'll limit the loss that happens. But what ends up actually happening from a practical perspective is, if this happens on a large scale, all of the swapping of assets creates an enormous ripple effect. So Layman was unable to maintain their, they had inadequate liquidity to handle a lot of these events, and as a result, they went under, and nobody shored them up. So the question here is, what happens if Evergrande goes down? They are holding a lot of, assets. The value of these assets will, may have to be sold off to pay off creditors and so forth. So who is going to, how is China going to do that? So the interesting part about this is that, if you look at, certain stocks like Alibaba, they've taken a huge hit lately because of this. And so it's hard to say, what are the long-term impacts from this, especially if you're outside of China and don't really know what's going on. It's hard to tell, what will be the outcome. But there's actually some other things that are going on right now that are creating more problems for China. One of those is rising tensions with the U.S. So under the Trump presidency, China, the U.S. levied tariffs on Chinese goods. So you saw that 2017, 2018, and those increasing tariffs started to shift some of the manufacturing to other countries. Under the Biden presidency, things are looking like there's going to still be that maintaining that tension. And one of the things that was announced today is military flights over Taiwan from China, which is causing, a potential, increasing, I should say, the tensions between China and the U.S. As the U.S. has a severe concern, that if China takes over Taiwan, they own. First of all, it's a aggressive military threat, but also there's a lot of manufacturing, especially semiconductors and chips, which are already fairly supply constrained, occurring over Taiwan. So there's a lot of knock-on effects here that could be causing problems. So the biggest risk I see, for this is China has a lot of input prices. Things like energy are going up. There was actually an oil spill in California, which tends to cause short-term spikes in the price of oil, as well as natural gas going up by 500% as a result of suppliers not being able to provide the supply of oil or natural gas or other things fast enough for rising demand as the world kind of exits COVID lockdowns. And because of that, the energy prices are increasing significantly. Well, that also has an impact on China's ability to manufacture, because they don't have, if they are spending a certain amount of money on, or expecting to spend a certain amount of money on pricing, well, that raises the price of the inputs, makes their goods more expensive, and then, that reduces the amount of purchase from the rest of the world as a result. So this is all creating a lot of, headaches right now. So how do we interpret that, right? What do we do with these kind of things? Well, as Charlie Munger, always talked about, a great business will operate well in any kind of environment. And the best businesses are the ones that are able to weather the storm of these kind of, shock events. And you may be able to get one for very cheap right now, as a result of that. So looking at, some of the giants in the Chinese market, Alibaba, Tencent, and so on, JD, there are lots of companies that, are worth, have gotten, 30, 40, 50% reductions from their peaks or more. And now is an opportunity to kind of investigate those and see which companies have, a strong moat, which companies would be able to weather a recession in China, which I think is likely to happen as a result of this. Doesn't necessarily mean it will happen, but but regardless of whether it will or will not happen, there is a significant decrease in the price of these. But I don't think their value long term is going to be threatened as a result of this. So there may be some short term hiccups, but long term, I think you'll see some significant upside from these as the economy recovers. So, but again, every investment requires, significant thought as to what is going on. How would you interpret this? And then as new information comes in, you have to kind of evaluate your thesis. So I think the most important thing you can do is go through your checklist, identify what is going on for each one of these businesses that you have an interest in. And then, go through the checklist and identify what could happen in the worst case scenario and value the business based off of the worst case scenario. And if there is still a significant decrease or a significant difference in the price and the value, then make your purchase, right? So none of the things that we've talked about for, 2 or 3 years now are different. It's just that other people may be selling for, various reasons. We don't really care why they sell. We just care, is the price and the value, significantly different from each other. Okay, so we're going to close on that topic. If you're interested in reaching out to us, message us with info@valueinvestor.org. We would really appreciate it if you'd leave a comment, like this video, and subscribe to the channel. That helps us grow our user base, gets us more visibility, and then gets us to put out more content. And if if you have any questions or any companies that you'd like us to talk about, please email us to at info@valueinvestor.org. We're happy to also send you that checklist that we just talked about. If you if you send us that email. So we'll stop right there. In the next episode, we'll be talking a little bit more about the U.S., how the rising energy prices, stagflation, China tensions are going to affect the United States. What does that mean for your portfolio, and what you can do right now to kind of understand the market better. All right. Well, we appreciate it, and we'll see you on the next episode. Thanks.